$5,589. That was the all-time high that gold hit just 6 weeks ago on January 30th of this year. And right now, as you're watching this video on Saturday, March 14th, 2026, gold is sitting at $5,023 per ounce, down roughly 2% just today, down over $500 from that peak in less than 7 weeks. And the headline you're going to hear all weekend is, "Gold is crashing, gold is in free fall, smart money is getting out." But here's what they're not telling you. The story happening underneath that price move is one of the most contradictory, most revealing things I've seen in years of watching these markets. Because while the number on the screen is falling, the physical reality on the ground is pointing in an entirely different direction. And on Wednesday, March 18th, 4 days from right now, the Federal Reserve is going to announce its interest rate decision. And virtually every single market participant on the planet already knows what they're going to say. So the real question is not what Jerome Powell says on Wednesday. The real question is what happens to your gold, your savings, and your financial position the moment the dust settles. Stay with me for the next 20 minutes because by the end of this video, you're going to understand exactly why this dip is happening, whether it's real or manufactured, what history says comes next, and how the smartest money in the room is actually positioning right now. Let me give you the full picture of where we are today, because context matters enormously here. Gold hit $5,589 per ounce on January 30th, 2026. That was, at the time, its worst single-session drop since 1983. It fell 9.8% in one day. JP Morgan looked at that crash and, according to their research notes, described it as positioning-driven rather than a fundamental shift, and maintained their full bullish outlook without flinching. That's the same JP Morgan that has a year-end target of $6,300 per ounce on gold right now. $6,300. From $5,023 today, that's a 25% move they're expecting before December 31st. Deutsche Bank has a $6,000 target. UBS is sitting at $6,200 for mid-year, and Societe Generale just upgraded their forecast to $6,000 as well, noting that even that might be conservative. Now, I'm not saying those forecasts are guaranteed. Nothing in markets is guaranteed. But when every major institution on Wall Street is pointing in the same direction, that's not noise. That's a signal worth paying very close attention to. So why is gold falling right now if the long-term picture looks that bullish? Let me explain what's actually going on, because the mainstream financial media is giving you a simplified version that's missing half the story. The immediate culprit is what's called a liquidity event. Here's how it works. When Brent crude oil surges past $100 a barrel, which it did in early March when the US-Israeli conflict with Iran escalated and effectively choked the Strait of Hormuz, institutional investors start getting margin calls on everything. Not just energy positions, but their entire portfolio. And when you need cash fast, you sell your winners first. Gold was up 19% year-to-date as of early March. Silver was up 16%. Those are profitable positions, easy to liquidate. So what happened is not that investors stopped believing in gold. What happened is that investors needed dollars, and gold was their most liquid profit sitting on the table. According to analysis from City Index and Forex.com, this is textbook flight to liquidity, a flight to cash, not a flight away from gold as a concept. Before I go any further, quick message for those of you who aren't subscribed. My analytics show that roughly 3 out of 4 people watching right now haven't hit that subscribe button yet. If this kind of analysis is cutting through the noise for you, if you appreciate getting the real numbers and the full picture rather than just the talking points, then hit subscribe. That's how I know who the committed community is. It helps the algorithm show this content to more people who actually need it. And frankly, it helps me understand what kind of depth you're looking for. All right, let's get back to what's driving this market. The second force pushing gold down is the stronger US dollar. The US dollar index, the DXY, hit a 3-month high of 99.69 during the peak of this week's selling pressure. And here's the mechanical reality. Gold is priced in dollars globally. When the dollar strengthens, gold automatically becomes more expensive for every buyer using euros, yen, rupees, or yuan. That reduces demand and prices fall. The dollar is strong right now because of oil. When oil surges, money flows into dollars because oil is traded in dollars. The more expensive oil is, the more dollars the world needs to buy it. It's a feedback loop that's completely disconnected from whether gold is actually a good store of value or not. Now here's the critical thing to understand about the dollar's strength right now. This isn't because the US economy is in great shape. Core inflation came in at 2.5% year over year in February. That was the reading released on March 11th by the Bureau of Labor Statistics. Headline CPI was 2.4% annually. Those numbers are above the Fed's 2% target, And according to the University of Michigan's latest survey, released just yesterday, one-year inflation expectations jumped to 3.4%, snapping a 6-month streak of declining expectations. Consumer sentiment overall hit 55.5, the lowest reading since the beginning of this year. Americans are feeling the squeeze of higher gasoline prices, and they know it. Now let me show you why the Fed's meeting this Wednesday is so absolutely critical to understanding what happens next to gold. According to the CME Group's FedWatch tool, and I check this every single day, the probability that the Fed holds rates unchanged at the March 18th meeting is sitting at virtually 100%. Not 90%, not 95%, nearly 100. The current federal funds rate is 3.5 to 3.75%, and it has sat there since the Fed's last cut in December 2025. At the January 28th meeting, the Fed held, with 10 of 12 voting members in favor of no change. 2 dissented, Stephen Moran and Christopher Waller, and they wanted to cut by a quarter point. But 10-2 is a decisive hold. And now with oil at $100 a barrel, with inflation expectations ticking back up to 3.4%, the Fed has even less room to maneuver than they did in January. In a note released March 12th, CNBC reported that Goldman Sachs officially pushed their next expected rate cut back from June all the way to September. And traders in the Fed funds futures market have gone even further, pricing in only one cut this entire year, now expected in December. Not summer, December. Here's why that matters for gold, and here's where the story gets genuinely interesting. People think gold goes up when the Fed cuts rates, and that's partially true. Gold tends to do well in low-rate environments because it yields nothing. It competes with bonds and savings accounts for your money, so when rates are low, the opportunity cost of holding gold disappears. But here's what gold did in 2025, the year when the Fed cut rates 3 times. It surged 64%. 64% in a single year. And here's what gold has done in 2026, with the Fed on hold and rates elevated at 3.5 to 3.75%. It went from roughly $4,300 at the start of the year all the way to $5,589 by late January. That is a 30% move in just 3 to 4 months, with rates high and unchanged. So the story that gold can only rise when the Fed cuts is simply not accurate anymore. We are in a different monetary environment than anything we've seen in decades, and you need to understand why. Let me take you back through 3 historical moments that show you a pattern I think is playing out right now, because history doesn't repeat exactly, but it rhymes in ways that are almost eerie when you lay the data side by side. First, look at 1971. The U.S. closed the gold window. President Nixon severed the link between the dollar and gold. For the next decade, gold went from $35 per ounce to $850. That's a 2,300% increase over roughly 9 years. But here's the detail most people don't know. Within that 9-year bull run, gold had multiple drops of 15, 20, even 25%. In 1975, after running from $35 to $195, gold dropped 47%, almost cut in half, before resuming its march to $850. People who sold at the bottom during that correction locked in a loss. People who held or bought more participated in the full bull market. Second example, the 2008 financial crisis. Gold peaked in March of 2008 at just over $1,000, then crashed down to $712 by October, a 29% decline in 7 months. The reason? Exactly what's happening now. Liquidity crisis. Institutions sold gold to cover margin calls elsewhere. Then from October 2008 to September 2011, gold went from $712 to $1,900, a 167% gain in 3 years from the exact bottom of that gold is crashing moment. Third example, and this is the one that gives me the most pause when I look at what's happening today. In early 2022, Russia invaded Ukraine. Gold initially spiked on the geopolitical shock, then sold off as the dollar strengthened and the Fed raised rates aggressively. People said the gold bull was dead. From September 2022 through October 2023, gold essentially went nowhere, consolidating between $1,600 and $2,000. And then? From October 2023 through December 2025, gold went from $2,000 to $4,300, then to $5,500. A more than 175% gain from that boring consolidation period. The pattern is consistent across every major gold bull market in modern history. You get a structural driver: debt, war, monetary debasement, institutional distrust of fiat currency. You get a powerful initial surge. You get a sharp correction that terrifies retail investors into selling. And then the bull resumes. usually with even more force than before. Now, where are we in that pattern today? According to the World Gold Council's latest research, central banks bought nearly 1,000 tons of gold annually for 3 straight years. This year, JP Morgan expects that to be around 755 tons, still nearly double the historical pre-2022 average of 400 to 500 tons. The World Gold Council found that 95% of central banks surveyed, the highest share ever recorded in the history of the survey, expect gold reserves to increase over the next 12 months. 95%. And 43% of governments plan to actively increase their reserves in the near term. That's also a survey record. Central banks aren't buying gold because it's going down. They're buying it because they're losing confidence in something else. You don't have to guess what that something else is. Now let's talk about what's actually happening in the physical gold market right now, because this is where the disconnect between the paper price and physical reality becomes genuinely alarming. The spot price you see on your phone, $5,023, that's the COMEX price, the futures market price. It's the paper price. It's the number determined by people trading contracts, most of whom will never touch an actual gold bar. But here's what's simultaneously happening in the physical world. According to reports this week, in Hanoi, Vietnam, long queues formed on Tran Nhan Thong Gold Street on March 14th, today, as people lined up to buy physical gold. One major dealer, Bao Tin Min Chow, stated that customers purchasing 4 taels or more will not receive their gold immediately. They'll receive a receipt and pick up on March 25th. Read that again. They can't deliver gold to buyers on the same day. They're issuing IOUs for physical delivery over a week away, in the middle of a supposed gold price crash. Does that sound like a metal nobody wants? In India, despite the price dropping, analysts noted that the decline may present fresh entry points, with domestic demand from the wedding season providing a structural floor. In China, and I want you to remember this, the Shanghai Gold Exchange premium over London spot prices has been consistently elevated, meaning Chinese buyers are paying above the global market price because they want physical gold, and they'll pay extra to get it. That's not the behavior of a market collapsing. That's the behavior of a market where physical demand is running ahead of physical supply, with the paper price temporarily overwhelmed by currency and liquidity dynamics. Here's what makes this truly alarming when you step back and look at the full picture. Brent crude oil is trading above $100 a barrel right now. The Strait of Hormuz, the narrow waterway through which approximately 20% of the world's entire oil supply flows, roughly 20 million barrels per day, has been partially blockaded since early March. According to analysis from Financial Content, daily tanker transits through Hormuz dropped from an average of 24 vessels to just 4 during the peak of the disruption. 4. That's an 83% collapse in traffic through one of the most critical energy choke points on the planet. Iran has reportedly deployed mines in the waterway. Energy infrastructure has sustained damage. This is not a 2-day news cycle story. This is a structural disruption to global supply chains that economists are already warning could trigger a 1970s-style stagflationary spiral. And what happened to gold in the 1970s? It went up 2,300%. I'm not predicting that. I'm showing you the historical precedent when oil shocks and monetary debasement collide. Now, the stagflation scenario is genuinely the worst nightmare for the Federal Reserve, and it's the scenario that puts gold in the most complex position short-term. Here's the problem Powell faces. Stagflation means high inflation and slowing economic growth simultaneously. Normally, the Fed fights inflation by raising rates. But if growth is also slowing, and consumer sentiment at 55.5 is the lowest since January, with Americans already struggling with higher gasoline costs, raising rates crushes growth further. The Fed can't cut because inflation is above target. The Fed can't raise without crashing the economy. They're stuck. That's the higher for longer trap. And as Fawad Razakzada at City Index explained it this week, damage to energy infrastructure and stalled tanker traffic through Hormuz have lifted the risk of sustained strength in oil, gas, and refined products, stoking inflation fears and pushing back rate cut expectations, leaving gold with little support. That's the bear case in a nutshell. But here's Bob Habercorn at RJO Futures on the other side.
This dip in prices is likely to be short-lived, and flight to safety flows driven by geopolitical risk should support higher gold and silver prices.
So you've got 2 credible market analysts pointing in opposite directions on the short term. Both can't be right simultaneously. But notice what they agree on. The long-term structural story for gold has not changed. The disagreement is about timing, not direction. Stick with me because this next part is critical, and it's where most analysis completely misses the real story. Let me show you the smoking gun that separates this dip from a genuine reversal. Gold surged 64% in 2025. Going into 2026, it tacked on another roughly 22% before hitting $5,589 on January 30th. At that peak, futures positioning was extremely long, meaning a lot of leveraged institutional money was betting gold goes higher. When the Iran conflict sparked an oil shock and margin calls started hitting, those leveraged long positions got forced out. The selling wasn't driven by a change in fundamental belief about gold. It was driven by mechanical margin call liquidation. You can verify this yourself by looking at COMEX commitment of traders data. It shows you the positioning of commercial traders, large speculators, and small traders. When large speculators get forced out of longs at the same time, you get exactly the kind of sharp, fast sell-off we've seen over the past 2 weeks. And here's what history shows happens next. JP Morgan's research specifically addressed the January 30th single-day crash, where gold fell 9.8% in one session, the worst day since 1983. Their conclusion, according to their published notes, the move was positioning-driven rather than a fundamental shift. They maintained their $6,300 year-end target. They didn't flinch. When JP Morgan calls something their highest conviction long and doesn't move their target after a near 10% crash, that's telling you something specific about how they view this dip. Let me now show you the structure of what's about to happen on Wednesday, and why this weekend is actually a fascinating moment to be paying attention. The FOMC meeting runs March 17th and 18th. The policy announcement comes on the afternoon of March 18th, followed by Jerome Powell's press conference. The market is pricing in a 100% hold. So why does it matter if everyone already knows the answer? Because it's not just about the rate decision. It's about the language. It's about the dot plot, the Fed's summary of economic projections, which tells you where members think rates will be at the end of 2026, end of 2027, end of 2028. At the January meeting, 2 members dissented and wanted cuts immediately. If those 2 get any new allies in the dot plot, that's a signal. If the median projection shifts, that's a signal. If Powell's language around data dependent changes even slightly, if he starts hinting that a summer cut is possible again, or alternatively if he starts hinting that rates might actually need to go higher, the gold market will react violently. According to CNBC's reporting from March 12th, Goldman Sachs pushed their first expected cut from June to September. If Powell's Wednesday language validates that or pushes it even further, gold takes another leg down short term. If he signals that cuts could come sooner than September, especially with consumer sentiment at 55.5 and economic growth showing signs of stress, gold bounces hard from these levels. So let me make this personal and practical, because that's ultimately what matters. What does all of this mean for you specifically? First, and I want to be very clear that none of this is financial advice, and you should consult a qualified financial professional before making any investment decisions. But from a purely analytical standpoint, here's how to think about what you're seeing. If you currently hold physical gold, the narrative that has driven gold from under $1,000 in 2018 to over $5,000 today has not been invalidated by a 2% move on a weekend in March. Central banks are still buying at historically elevated levels. Global debt has not gotten smaller. The U.S. is running structural deficits with no credible plan to stop. Those are the underlying drivers. A short-term dip triggered by oil, margin calls, and a strong dollar does not change those drivers. Second, if you're watching this and wondering whether to buy, note what I said earlier. Gold had a 47% crash in 1975 inside a bull market that eventually returned 2,300%. It had a 29% crash in 2008 inside a bull market that then ran another 167%. This 2% dip, or even a deeper correction toward the $5,000 support level, does not automatically mean the bull is over. Third, pay very close attention to the $5,200 level and the $5,000 level. According to Light Finance's technical analysis, support and resistance for the week of March 16th are expected around 4,996 and 5,266 respectively. If gold holds above $5,000 through the Fed announcement, that's a significant technical signal. If it breaks below 5,000, the next major support zone cited by analysts is in the 4,800 range. Fourth, and this is the one most people get wrong, don't make your decision based on what happens immediately after the Fed announcement. The initial reaction is almost always a whipsaw in both directions. The real move comes in the days that follow, when the market has time to digest the actual language and compare it to expectations. Fifth, watch the US dollar index. The DXY hit 99.69 at the peak of this recent strength. If you start seeing it pull back from that level, if the dollar weakens, that's historically one of the most reliable early signals for a gold recovery. The World Gold Council's February 2026 commentary noted specifically that the dollar bounce, boosted by the current conflict, is likely short-lived, and a resumption in the downtrend should be supported for gold. Sixth, keep your eyes on COMEX warehouse inventories. When physical gold is actually flowing into or out of COMEX vaults, that tells you about the real physical demand balance, not just the paper market. According to data from Brave New Coin cited in earlier analysis, warehouse stockpiles have been dropping to alarming lows, suggesting physical demand is outpacing supply. If that trend continues while the paper price stays under pressure, the divergence between paper and physical only grows more dramatic. And seventh, and I think this is the most important practical point of all, position sizing and diversification matter more than timing. The analysts who are bullish on gold to 6,000 or beyond are not saying put everything you own into gold today. They're saying maintain strategic exposure as part of a balanced allocation. Most institutional strategists suggest between 5 and 15% of a diversified portfolio in precious metals, depending on your risk tolerance and time horizon. Here's what I want you to take away from all of this before I bring it full circle. Gold's all-time high was $5,589, hit just 6 weeks ago. Today, it's at $5,023. That's a drop of $566, or about 10.1% from the top. Meanwhile, JP Morgan, Deutsche Bank, UBS, Societe Generale, BNP Paribas, Goldman Sachs, Bank of America, Citigroup, virtually every major financial institution on the planet has a year-end 2026 target for gold that is dramatically above today's price. The lowest credible estimate I've seen is Goldman Sachs at 4,900, and even that was written before gold was already above 5,000. The consensus is somewhere between 6,000 and 6,300, and JP Morgan has a scenario, not their base case, but a modeled scenario, where household gold allocations rising from 3% to 4.6% of assets under management pushes gold to 8,000 to 8,500 per ounce. That's not a fringe number from a newsletter. That's a scenario modeled by the largest bank in America. The people who got hurt in 1975 weren't people who held gold through a 47% drop. Those people ended up with a 2,300% gain over the full cycle. The people who got hurt were the people who panicked at the bottom and sold, locking in losses while the bull resumed without them. The people who got hurt in 2008 weren't people who held through the crash. Those people made 167% over the next 3 years. The people who got hurt were the ones who couldn't stomach the volatility in October when everything looked its darkest. Right now, gold is down about 2% today on a weekend when most of the world's major exchanges aren't even open. Oil is above $100 a barrel. The Fed is holding rates at 3.5 to 3.75% because inflation is still above their target. The Strait of Hormuz is partially blockaded. Consumer sentiment is at its lowest point since January. Central banks around the world are buying gold at historically elevated rates, with 95% of them expecting to hold or increase their gold reserves. The US dollar index is near a 3-month high, which has historically preceded a period of dollar weakness and gold strength. And 4 days from now, Jerome Powell is going to stand at a podium and tell the world, with essentially zero surprise, that rates aren't changing. The question is what he says about the future. And whatever he says, the structural story doesn't change. Bring this full circle with me. I opened with $5,589, the all-time high 6 weeks ago. Today we're at $5,023. The headline says, gold is crashing. But the evidence says something far more nuanced. Central banks are buying at near record pace. Physical demand is so strong that dealers in Vietnam are issuing 10-day IOUs because they literally don't have the gold on the shelf. Every major Wall Street institution has a year-end target well above today's price. The dip is real, but the driver is a liquidity event and a currency move, not a fundamental change in why gold has more than doubled in the past 2 years. The Federal Reserve meeting in 4 days will likely produce exactly what the market expects, a hold. But the language around that hold could reshape gold's next move dramatically. The historical pattern across 1975, 2008, and 2022 is remarkably consistent. Sharp corrections inside bull markets create the most dramatic entry points. The people who acted at those moments, who understood the difference between a structural driver and a temporary technical sell-off, those are the people who captured the most extraordinary gains. The signs were there in each of those previous moments. The data was available. Most people just weren't watching closely enough. Right now you've been watching. You have the data. The question is whether you're going to remember it when it matters. Drop a comment below and tell me this. Are you watching Wednesday's Fed announcement live? And what language from Powell do you think would have the biggest impact on gold? Specifically, what do you think he'll say about the Strait of Hormuz, oil prices, and their inflation projections? I read every single comment on this channel. Your perspective genuinely helps shape what I cover next, and I've gotten some of my best video ideas from this community over the years. If you want to see my full breakdown of what happens to gold and silver specifically in each Fed scenario on Wednesday, bullish language, bearish language, and neutral, I've got that analysis coming. Subscribe so you don't miss it when it drops. And remember, this is analysis, not financial advice. Do your own research, consult a qualified professional, and never put more capital at risk than you can afford to lose. I'll see you on Wednesday.